Hey everyone, and thanks for jumping back into the cryptoverse. Today we're going to talk about Bitcoin, and we're going to be looking at risk management using the risk metric. So if you guys like the content, please go ahead and subscribe to the channel, give the video a thumbs up, and also let me know what you guys think about the video in the comment section below. We also have a Telegram channel that you can check out if you want to discuss these charts, as well as my website if you want to join the premium list. So let's go ahead and jump in. So if you follow the channel, you know that we've been talking about this risk metric for quite a while now, and I just wanted to give everyone an update. For those who are unfamiliar with the risk metric, what we're doing here is we're just plotting the price of Bitcoin versus time. Okay. Note that the y-axis here is a logarithmic scale, so each move up from major tick to major tick is 10x. Okay. It's also color-coded by the risk level, and the risk level goes from 0 to 1. If it's dark blue, it means the risk level is historically low. If it's dark red, then it means it's historically high. Now, the equation for this is not based anything other than just price, time, and volatility. I don't actually publish the equation. It's something that I just keep to myself. But if you want to follow along, you can certainly continue to watch these videos to see where the risk level is. So one of the things you notice is that during the accumulation phases before a speculative bubble top, we always get into this darker blue region at some point. You can see back in 2010 we were in this region early on, and then we came up to our speculative bubble peak, which corresponds to a risk level of above 0.8 or so. We came back down into our new accumulation region. We came up into our new speculative bubble peak, and this was the cycle where we actually had two peaks, and it actually predicted both. I shouldn't say predicted both, but once we were in that speculative bubble regime, it was signaling that, okay, the risk now is extremely high. It might be worth considering to DCA yourselves. Now, again, this is not financial advice. This is just a metric that I made and I use. Going into the next cycle, we saw an accumulation phase here before ultimately going parabolic, and it took a longer period of time, as we talk about significantly on the channel, and the idea of lengthening cycles. We had our last peak in 2017, where it also flashed in the 0.9 to 1 risk regime. It has since come down, and then it finally dropped down into that lower blue region, the ultimate buy region, and we even revisited this over here a little bit later. Now, this only shows the drop down to around, and so this is 1,234. So if you were to go over 234, this doesn't even show the absolute bottom because it's daily data, not minute data. So the absolute bottom would have been a little bit lower down here when we went to $3,800. But still, you can see that it does a decent job of trying to identify, okay, these are the times where it's historically better to sell, and these are the times where it's historically better to buy. Now, continuing on in this fashion, we've removed the color from the price so that you can just quantify it on the secondary y-axis. So you can see the risk goes from 0 to 1, and this orange line here is the risk. So you can see what it does at each peak. And the nice thing about it, okay, is it's not a lagging indicator. The way I have it, it actually tells you, it sort of front runs it in a sense. It tells you right when the peak is occurring, so that okay, historically speaking, we only spend, only a short period of time above a risk level of 0.8 and 0.9. If you're continuing to hold, thinking that we're just going to go to $1 million, you might want to question your resolve on that, because that's certainly not what the data suggests. So I want you to take that into consideration. This risk metric does take into account the fact that we are experiencing lengthening cycles, okay, and it takes into account diminishing macro level of volatility. So it assumes that the volatility over the macro scale, which we've proven time and time again on the channel, is reducing. Okay, so those are the two things you need to understand about this model. So if we were to just look at the time spent below, say, a risk of 0.2, you can see that it's actually not that often when we're below this level. In the recent drop, we dropped down to a little bit above 0.2, but had I put on here the price at $3,800 and the corresponding risk level, for those who have followed in the past, you'll know that the risk level at $3,800 was 0.12. So it was actually right down here, similar to where the risk level was here. Now, the risk level changes dynamically through time, not historically. Like, these values aren't set to change, But in the future, the risk level right now is 0.4 or around 0.395. In a year, the risk could still be 0.395, but the price of Bitcoin could be, $13,000. So the risk level, it takes into account more of a slowly maturing asset. It's okay. The risk level is still relatively low. But if you go into a speculative bubble parabolically, then the risk level is going to shoot up. Now, in the same manner, if you look to see the times that we were above 0.8, it's also relatively short-lived. I mean, it hasn't happened very often. When we are above 0.8, you can see we only spend a few days in that risk regime. Okay, so this is the key indicator that we're hoping to use for this next cycle to say, okay, you know what? Despite the fact that my greed is getting the better of me, and I see Bitcoin at $100,000, the year's like 2023 or something, I'm not just going to assume that it has to go to 500,000. I'm going to say, wait a second, I've lived through this before. I don't want what happened last time or what happened the time before to happen to me again. Therefore, I'm actually going to take profits this time to give me and my family a better life. This is the idea. I can honestly tell you, I've never regretted DCAing my sells. Okay, I've never regretted it. But what I have regretted is not selling. So when I first got into the market a long time ago, you kind of experience it. You kind of experience your first bubble, and then you recognize what's what. And you learn from your mistakes, and you either learn from your mistakes and become the smart money, or you just continue to be the dumb money every single cycle. You buy the peak in 2013, and then you FOMO in back over here, and then you think it's going to go up and up and up, and then it doesn't. And then once again, you're proven to be the dumb money. The idea is when the market is boring like it is right now, despite the fact that we could go up and down several K, what's a few K among friends, guys? We're talking about a theoretical move of Bitcoin to six figures, hopefully in a few years. So a few K now, while I understand it can indicate, it can drastically change your ROI at the end of the day, you have to forgive yourself for not knowing what the price of Bitcoin is going to do in the short term. After all, I think the short-term behavior is largely irrational, and it's more of like random walk, like Brownian motion type thing, rather than like that's something you can realistically predict. So it's better to have a plan than not to have a plan. If you draw, these patterns from bottom to top of the risk metric, you can see that each concave down pattern, you can see it's being stretched and stretched. So this first one was here. I mean, obviously on this one, we only have the second half of it because Bitcoin didn't exist all the way back then, and we don't have reliable price data for it anyways. And then you can see here, this was our first concave up pattern. Our second one, I guess we also have concave down patterns. It depends on if you're looking from bottom to peak or peak to bottom. But these concave up patterns, you can see that this one is number one. This one is getting stretched as number two. And I'm projecting that this one will continue to get stretched as number three, and that we'll see a peak sometime out in 2023, plus or minus 6 or 8 months. I don't contend to know when the peak will happen, but I do think that there's a likely chance that we'll see a peak sometime out in that time frame. I don't think the chances we see a peak in 2021 are so low. I don't even think it's worth even talking about much more. So the idea is, well, if we can use this metric to account for diminishing returns and lengthening cycles, then despite the fact that from bottom to peak will be a less of a return on your investment from the last cycle, the idea is the risk metric accounts for that. So you don't have to. This is the whole idea. Now, if we are able to get up to a risk level of 0.9 to 1, you have to recognize that it's likely going to be short-lived. At the same time, what happens if we don't make it to a risk level of, say, 0.95? Do you want to not sell at this point on the hopes that we make it up to here? This is not a good strategy in my eyes. This is not financial advice, but what you should do is have a plan on how you're going to buy and how you're going to sell. So I just drew a random line to kind of give you an idea of what could happen over the next several years in terms of the risk metric, which would continue this pattern that you see right here on this chart. Now, how do you use this to your advantage? Do you only sell when the risk gets to 0.9? Do you sell at other time frames? Well, I'll tell you what I do. I buy when the risk is between 0 and 0.5, and I sell when the risk is between 0.5 and 1. Okay? Now, you might be wondering, well, how do I buy? How do I sell? Well, there's a lot of different ways you can do it. If you follow the channel for a while, you'll know, the two main strategies that most people follow, or the main strategy that most people follow is just statically DCAing your way into the market and then potentially statically DCAing your way out. So this means, you just continue to buy, maybe you're putting in, say, $500 a month, or you're putting in $2,000 a month, whatever it may be, and you're just doing that every month or every week, and you're just continuing to stay on that track. You don't care what the price of Bitcoin does. And this is a fine strategy. There's nothing wrong with that. In the same manner, you could sell 20% at each risk level. And you may say, well, Ben, why would I want to sell at 0.5 or 0.6 when theoretically it's going to go to 0.9? Well, first of all, remember, no one knows what's going to happen. Okay, no one knows what is going to happen. If you went into the last mini bubble that we had in 2019 with that idea, you would not have taken profits between 0.5 and, over 0.6. Whereas hindsight, you probably wish that you would have, because you can see that we came back down. There's a chance, a non-negligible chance, that we come back up into this level and then come back down. Okay, so this is ultimately the idea. We don't know what's going to happen, therefore we take profits when we can, because it ensures that you're continuing to make money on your investments. You can reallocate that money somewhere else. So you could put it into Ethereum, you could put it into a different asset class. The idea is that you're continuing to make money, and you're not just putting your money in and never seeing an actual return on that investment. What I do, however, is I dynamically DCA. So what I do, if you're not familiar with the strategy, is when we're in this risk level up here, I buy X. So imagine X, let's just say I'm doing, just as an example, let's say I'm doing $1,000 a month. Okay, let's say this is what I do. Then when the risk is between 0.4 and 0.5, I don't actually do $1,000 a month. What I do is I take an X value. So I figure out what X is going to be. So let's say that my X is $500, because I normally would want to do $1,000 a month, but I want to leave myself room to put in more money some months when the risk is lower. So I say, okay, you know what? My X is 500. So if the risk is between 0.4 and 0.5, I'm going to put in $500 that month. If the risk is between 0.3 and 0.4, I'm going to put in 2X, or $1,000 that month. If it's between 0.3 and 0.2 and 0.3, 3X, I'd be putting in $1,500 that month. The amount of time we spend at these levels down here is few and far between. And this is the reason you always should have, at least for me, I always have capital on the sideline so that I can take advantage of a move to the downside. Because when we go down to these levels, we don't spend very long there. This is when, all the dumb money is capitulating, but the smart money is not. This is when the smart money recognizes an opportunity when they see one, and they take advantage of it. And this is why I say, I don't know if we're going to return to this risk level during this market cycle or not, but you must always be ready for it. As they say, that quote, you don't seek out the 200-week moving average, but you must always be ready for it. Now, if we were to continue this, then to give you an example, let's say you've accumulated all your Bitcoin, and now the risk level enters 0.5, and you're wondering, well, how should I sell? Well, instead of doing 20% at each level, what I do is I dynamically DCA my sells. And I do it based on this linear model. So just Y plus 2Y plus 3Y plus 4Y plus 5Y equals the total number of Bitcoin I have. So if I have, say, if I solve for this equation, then Y equals the total number of Bitcoin divided by 15. So if you had 10 Bitcoin, let's say by the time the risk gets above 0.5, let's say you have 10 Bitcoin. Well, what you would do is you would figure out what your Y is. It turns out to be 0.67 Bitcoin. And then when the risk gets to this level, you sell 0.6. When the risk gets to 0.6 to 0.7, you sell 1.33 Bitcoin. When it gets to 0.7 to 0.8, you sell 2. When it gets to 0.8 to 0.9, you sell 2.67. And when it gets to 0.9 to 1, you sell 3.33 Bitcoin. That way you're continuing to sell more as the price and risk increase. But it gives you the opportunity that if you sell, let's say you sell 2 Bitcoin between the 0.5 to 0.7 risk level, and then it comes back down, well, then you took profits and you could reinvest. And then the next time you calculate your total number of Bitcoin, when you enter the 0.5 risk regime again, maybe you have 16 Bitcoin. And then you just continue to repeat the cycle. There's a lot of people that watch this channel that are only interested in cryptocurrency. But I can assure you, and please give me a little bit of... give me some wiggle room here. There are other asset classes besides crypto. I'll say that one more time. There are other asset classes besides cryptocurrency. So the idea is that you're putting money into crypto when it makes sense to put money into crypto. You're not putting money into crypto when Bitcoin's up 15x in 6 months. Okay, this is ridiculous in terms of risk management. This is just awful. Maybe you get lucky and the price goes up in the short term, but it's nothing more than gambling. What I would say now is putting money into the market during an accumulation phase is more of an investment. Yes, it's a highly speculative investment, but it's more of an investment. If you're putting in money in, the end of 2017 or the end of 2013, this is pure gambling, and I'm sure many of you watching the channel lost a lot of money during this time. So if you apply something, that's like quantitative finance backed by data science, you use this model to identify what you're doing in crypto, it reduces the stress, okay, completely reduces the stress. You just follow where the math takes you, and you remove the emotions, because how often have emotions served you well in this space? I'm guessing very few times have emotions worked out to your benefit. So this is the point. You go based on a model. It could be my model, it could be the risk metric, or it could be something that you make. You could make it based on whatever you want. The point is, if you're managing a portfolio of cryptocurrency, whether you're using my model or someone else's, it's important that you have a plan, because you need to come up with a plan now when the market isn't moving, so that later when it is moving, you can stay the level-headed investor. You're not the person that's FOMOing into the market when it's already at 10x. You're not the person capitulating when it's already down 80%. You need to come up with you figure out what your resolve is and just stick to it. And the rest is noise. Like literally the rest is noise. So the outlook for the channel is looking out to say 2023 plus or minus 6 to 8 months in terms of hopefully seeing a new speculative bubble top. This is at least the hope anyways. I do have a lot of other videos that do talk about that. Now, some of you don't like this approach. Some of you say, what, maybe I don't want to buy Bitcoin above 0.5 risk, but that doesn't mean I want to sell. And there are rational things to take into consideration. What if you don't want to pay short-term capital gains taxes? So let's say the risk gets to 0.5 and you just bought last week. You don't want to sell some of your Bitcoin because maybe you have to pay short-term capital gains and you have no interest in doing that. Well, what you can do is you can create like a gray region in a sense. And basically during this region, you just don't buy or sell. So you say, what, the risk level of Bitcoin, it's a little bit too high for my taste, back when it was say like 14K back in 2019. Instead, I'm going to put money into Ethereum, or I'm going to put money into a mutual fund, or I'm maybe going to put money into real estate, or precious metals, or commodities, whatever it may be, bonds. You just look at the risk, you say, yeah, it's a little bit too high for my taste. With that in mind, I'm not going to put Bitcoin into the market this month. So you could do that, and you could come up with, say, this is my gray region where I'm not going to be purchasing Bitcoin. And if we get up to this level, then I'll sell. So this is the idea. Now you can see this is the gray region here. Another option is if you're more conservative, you don't even like to buy up at these levels. All you ever do is you just put the bulk of your money in when the risk is between 0 to 0.3. So basically at the bottoms of our bear markets, and then you just ride the wave. This is all you do. And then you don't sell. You don't really care what Bitcoin does in here. It's just noise. It's not the dumb money capitulating at the bottom. It's not the smart money selling at the top. It's just noise. So what you do is you buy in this region and then you sell when it gets to this region. So again, this is ultimately the projection I see. I see it, ultimately getting back up to a risk level of hopefully above 0.8 sometime, maybe in 2023 or so. But remember, I don't know exactly where it's going to go. So this is why to just have a plan and stick to it. If you're now that I have you thinking about taxes, maybe you're thinking, well, what if I want to avoid short-term capital gains taxes? Well, first of all, do you believe in lengthening cycles? If you think that Bitcoin is going to peak at the end of 2021, which I don't think there's a snowball's chance of happening, then buying Bitcoin now, you're still not going to have to pay short-term capital gains if you sell at the end of 2021. But if you're buying in, say, the fourth quarter of let's say you're buying in like the second quarter of 2021, and then you're selling 2 months later, then you are going to have to pay short-term capital gains. Now, if you're doing that and the price of Bitcoin goes up 10x, then that's obviously a good problem to have. Paying short-term capital gains on something where you're up a significant amount is a good problem to have. But let's say you prescribe the lengthening cycle theory. Well, if you do, then you might want to consider that putting money in after, say, 2021 or maybe early 2022 would make sense in the idea that, okay, well, if we're going to see a peak in the year or two after that, then I don't want to continue putting money in the short term so that I can only pay long-term capital gains. And obviously this depends on what country you're living in, so I'm not going to dwell on it too much longer. I hope this has been informative. If you want, you can check out my premium content, and you can check out a dashboard that has the live risk level for Bitcoin, for Ethereum, for Cardano, and for Litecoin. You can find that on my premium list. So go to intothecryptoverse.com. You can sign up monthly. You can sign up for 6 or 12 months with crypto and get a discount. And if you do, you'll get access to a dashboard that has the live risk levels of these coins, and you'll get access to a weekly premium video and a weekly premium report. And I can assure you, I'm not just fluffing these reports up with emotions and stuff like that. Every single week we have a different topic that's normally requested by the people in that group, and then I cover that topic. This last week we went over modern portfolio theory and applying it to Bitcoin, Ethereum, and a few other coins, and identifying based on historical returns, what is, the best portfolio that maximizes your Sharpe ratio, which is your expected returns over your volatility or risk. So I hope to see you guys there. If you sign up, you'll get an email, so I'll see you in your inbox. Other than that, please subscribe to the channel, turn your notifications on, give the video a thumbs up, let me know about what you think about the video in the comment section below, and I'll see you guys next time. Bye.